Hi, I'm Robert Glazer from Ripe Chartered Accountants, and I'd like to introduce you to Perry Burns from Working Capital Partners Limited. Hi Perry, thanks very much for coming in.
My pleasure.
Would you like to start off by just telling us what Working Capital Partners Limited actually does?
Well, the clue is in the name. So we help businesses with working capital.
Okay.
So businesses that are growing, businesses that are finding it tight with working capital within the business,
Right.
we help them to get that cash that they need to grow.
Okay, and why did you set the business up?
Well, before Working Capital Partners, I was working in a consultancy, and we had a lot of clients who were trying to grow, trying to find capital, and they knew about factoring, but they didn't really want to commit their whole ledger. They really didn't want to have the pain of having to pay every month whether they used the facility or not.
Right.
And I started looking around on behalf of clients for something that would be flexible and cost effective.
Right.
And I couldn't find anything at all. And then one day I found a website and I thought, great, that's exactly what I need. The downside was it was an 818 telephone number in New York somewhere.
Right.
So I phoned them up and said, look, why can't I do this in the UK? And they said, we don't know. So I had a long conversation with them, got some more information, went to see a lawyer and said, why can't we do this in the UK? And they said, you can. So we did.
Okay. So what do you do that's different from traditional factoring?
So traditionally in factoring, a business has to sell its whole receivables ledger.
Its sales ledger?
So it's whole sales ledger, yep. And what they would do is they would have a minimum commitment every month. So there'd be an administration fee every month, and there'd be a minimum commitment, usually 18 months with a 3-month cancellation. So entering into a factoring agreement is very, very expensive. You've got a big jump to get into it, and then there's a lot of administration and quite a lot of interference.
There's a lot of due diligence as well, isn't it? Before you.
A lot of due diligence. So that doesn't actually go away. The due diligence is still there, but it's easier to cope with.
Right.
And there's also it's quite a lengthy process to get into.
Right.
What we've been able to do is to say, well, look, we'll cut all that out. We'll just make it very, very simple for you to go in. If you want to sell even as low as one invoice, you can.
Right.
So it makes it much simpler, effectively pay-as-you-go factoring.
Right.
So just a simple thing. Now, if businesses start doing more, then we can restructure it for them. But if they only want to sell one invoice, they can.
Okay. So it sounds like you found a gap in the market and you've filled it.
Yeah.
Is there any competition to what you do?
There are another couple of companies who do something similar. Each one of them has their own particular take.
Right.
We like to think that we're better than the others, but
sure you are.
That's up to the clients to decide, really.
Okay. And by way of background, working capital requirements, I guess, have traditionally come from the owner's back pocket, or from the banks, or from other sources. Do you want to say a little bit about them and in comparison to what you do? For example, when might it be suitable or more relevant or appropriate for them for our clients to seek those sources rather than yours?
Sure. Well, traditionally, when a business starts up, there's a need for capital within the business, and that will be everything from paying for initial stock, paying for premises, even getting the stationery printed. All those costs have to be paid for in advance, and that capital has to come from somewhere. Typically in a smaller startup, that will come from the owners themselves, but there's a limit to how much that they're going to be able to typically, and it's very difficult to put a number around it, but most people can get to 10, 15, 20,000. Once it gets beyond that, they're going to need additional help from other sources. They're going to need external investors, who will very often put working capital finance in.
Okay.
But the traditional source always has been the high street banks. So in the days of Captain Mannering, you would walk into your branch of your bank and say, look, here's my business plan. I need £20,000 because I've got to buy stock, and here's what I'm going to be able to do. And the bank manager would say, yep, that looks pretty sound to me. Certainly your overdraft is marked. It would be that simple. Well, today, they won't do it without a great deal of security. Their due diligence process is very, very lengthy. And frankly, unless the business plan is pretty much gold-plated, they probably won't give you more than a couple of £1,000. So it means that your traditional source has just completely dried up. So that really leaves you with very limited opportunities to get that capital. There's what the bankers like to call the 3 Fs. friends, family, and fools.
Yeah.
You can go to those people,
Sure.
and you will get a certain amount of capital, but it's not going to allow you to grow really at the pace most owners want to grow.
Yeah.
A lot of owners will fall back on things like credit cards, but of course that's really expensive financing and probably not the best way to fund a business. And of course a lot of them go to angels, so classic angels den kind of approach. But that is, not only is it expensive money, but you're giving away your most precious asset, which is the equity in the business. Sure. And if you're going, I saw one on Dragon's Den the other day where they gave away 30% of the business for £70,000. This is a business been going for 10 years. I just couldn't understand why the directors would do that.
Desperation.
Absolute desperation. And I think that what we've been able to do is, in that particular case, we would have been able to provide a facility for them at a fraction of the cost and give them all the flexibility they needed.
Sure. Are you finding that companies still have access to invoice discounting or factoring?
In what way?
In respect to funding working capital.
Oh, there are. For larger businesses, invoice discount. Let me just define the difference between.
Sure.
Invoice discounting is undisclosed. So in other words, they discount the invoice, but the customer doesn't actually know that it's been factored. In order to do that, the bank is usually going to want very, very rigid back office procedures within the client. So they're going to have very, very good control of their accounts receivable. They're going to have to have very good systems and processes, and they're going to be subject to audit usually 4 times a year, but often more than that, and subject to spot checks. Sure. It's a very onerous process. So typically for a small business, ID is not really available. Factoring is slightly different from that in that it is disclosed to the customer. In most cases, what a factoring company will do is it will take over the ledger in its entirety and will do the collection for you. So what we've done is we've created a hybrid between the two. So it is disclosed, but we don't do the collection. And what that means for the owner is that their relationship with their customer is not interfered. So as long as we know that it's a provable debt, in other words, the goods or services have been indisputably delivered, then we'll be able to fund that invoice.
Okay. And are you in a position to advise companies that come to you in terms of, we think it's best if you go this route, that route, and what would make you decide?
Well, first thing we do is we do due diligence on the company. So although we're not regulated, this is not a regulated industry, we are registered with the FSA, and as a registered business, we have to carry out due diligence and we have to behave as a responsible lender.
Okay.
So we only lend if we think that the business proposition makes sense.
Right.
And in order to do that, we need to make sure that the business is solvent. Right. And that there are things like the payments to HMRC have been made, and they're not about to get wound up by the taxman. We also need to make sure that there are no county court judgments against the business, and the business is being run with due diligence. Okay. And we do get businesses who come who had, shall we say, a difficult credit history. That doesn't necessarily rule them out, but it does mean say that there'll be some additional processes that they'll have to go. Most businesses can be factored. It may not necessarily be the best. If they've got security and the bank will support them, that's going to be the cheapest for them. Sure. So they should definitely go that way. They might, if it's a long-term lend that they need. So for example, they need to buy a piece of machinery which is going to have a 3 or a 5 year life. You're better to finance that over a 3 or 5 year period and do that over a length. So you have to match the kind of finance you want. But if it's working capital, in other words, the capital you need to keep the lights switched on and pay the staff and pay the rent and make sure your tax is up to date and pay your suppliers, very important. For those kind of things, working capital finance is the right thing to do.
Okay. You mentioned the banks, of course, and it's a very difficult time for our businesses and the banks. They say they're lending. Our clients say they're not. Do you have a view on that?
Well, the banks always tell us that they're open for business. What they leave out is the small print, which is as long as you can meet these criteria.
Yeah.
Very often that will be total security. So very often they'll want a charge over a marital home or something like that. Getting those securities in place can take a long time.
Yeah.
At best, 8 to 10 weeks, usually longer than that. And if you need working capital tomorrow, that's not going to help you. We also find with the banks that they sometimes apply very curious criteria. I had a client last week we've just signed out who had an overdraft facility with one of the big high street banks, and they came along to renewal time and they said to them, well, we're really pleased with the way you've been managing this, and we see that your turnover has topped £2 million a year. So they said, we're really pleased with that. They said, well, we'll continue our overdraft on the basis that you keep it at £2 million a year. Now, the problem with that was that they were in a slightly difficult market.
Right.
What that meant was they had to start chasing business at lower margins in order to keep their overdraft in place. It was completely counterintuitive. I mean, and I've discussed this with a couple of bankers, and they said, well, that's an absolutely daft covenant. Yeah. But that was the situation he was in. Yeah. What we've now done is we've taken his overdraft out, we've taken over his working capital facility, he's released his debenture from the bank, he's now dropped his turnover to about 1.6 million, but it's a profitable 1.6 million, and the future of the business is preserved. Yeah. So the bank was actually creating a situation where he was, if not doomed to failure, then certainly destined in that direction.
Yeah, you think the banks would be more concerned with profitability and cash flow than turnover.
Yeah, well, you know what they say. It's, turnover is vanity.
Absolutely, yeah. So who are your typical clients then?
Typically our clients are smaller businesses, usually owner-managed, but not always. Yeah. Usually 2 to 3 directors, again, can be bought, but often only a single director. Yeah. Usually turnover between £500,000 and £2 million. And providing some goods or services with a provable deliverable. Right. So as long as it's the kind of business where we can see that the goods or services have indisputably been delivered to a creditworthy customer. Right.
Does that include internet type businesses?
Yes, we've got a number of internet businesses, and we use online verification there. It's actually usually it's very easy to verify. But if they're selling to consumers, then this is the wrong kind of finance.
Well, often they would use PayPal and get paid straight away.
Exactly, yeah.
And what about startups?
Startups, again, as long as the credit history of the directors isn't too difficult. Yeah. Very often there might be a bit of history, but as long as there's a reasonable story that we can see behind that, and we feel that the directors want to go forward in a positive way, we can look at that. The two main criteria are a provable deliverable and a creditworthy customer. Right. Those two things are true, and also there should be a good reason for factoring. Right. So a good reason for factoring is not, I don't like to phone my customers up and ask them to pay their bills. That's not a good reason for factoring. Because the best way to get cash into a business is to get your bills out on time.
Yeah. Okay, so it's not the... Or how much of it is based on you knowing and trusting the individual directors? Is that a big
we know
factor?
every one of our clients individually. We work with them, and sometimes they'll phone up and say, "Look, we've got a bit of a problem, a short-term problem, and we might do an over advance for them or something in order to get them through a particular short term." Right. But they build up trust with us, and we build up trust with them.
So there's scope to do additional funding in exceptional circumstances.
Yes.
Okay, that's very interesting. Okay, and what are the risks to the companies that sign up with you?
Well, the main risk is that we rely on the integrity of the paper that's coming to us. So effectively, we're buying a piece of paper in return for which we're giving them folding green. Sure. So we need to make sure that our investment is properly secured. So in order to do that, we will be looking for a debenture on the business. In other words, that we take first position in the event of anything going horribly wrong. And secondly, we'll be looking for the support of the directors in the documentation.
In terms of personal
guarantees, yeah. Right. So that's really there to say when we're issuing invoices and we're saying that this is a real invoice, it really is a real invoice, and the directors are putting their own imprimatur behind that. However, in order to protect them, what we do is we then insure the debt on their behalf.
Okay. So that's part of the fee that they pay is the protection policy.
Correct. Okay. So as long as the debt is a real debt, if their customer goes bust, then they're protected against that.
Right.
To the tune of 90%.
Sure. Okay.
There is a slight.
So repay 10% to you.
Yeah. And that will mean that they're pretty well assured as if they've sold us the debt, they're going to get paid as long as the customer suddenly doesn't turn around and say, well, actually, there's no deliverable.
Yeah. And at what point, is there a 90-day term or something similar which you would seek recourse?
Yes. So generally what happens is that we go by the terms that they've given to their customers at 30 or 60 days. Yeah. The longest we'll take is 90. Right. We usually want repayment at least 30 days beyond term. Right. So if the terms were 30 days, when it gets to 60, we would be saying to the directors, you really either need to repay us the advance, you need to get the customer to pay, which would be the best possible thing, or alternatively substitute another invoice. If, on the other hand, the reason that it hasn't paid is because the customer said, well, actually, we're just not paying. We've just increased our terms from paying 30 days, we're now paying 90 days. Yeah. We would then put that into the hands of our insurer, and if they still wouldn't pay after 30 days, then that would trigger the policy.
Okay. And do does your client's customer pay you, or do they pay?
So the money is sent to us.
It's sent to you.
Yes. Okay. So once they've sold the debt, the debt is our debt, not their debt.
Okay. So if the customer doesn't pay, and presumably you take normal legal action to recover a debt from your client if need be.
Yeah, and very often the reason for non-payment is because it got lost in the system, particularly if they're selling to much larger organisations. I think one of the problems you have is if you have a small business selling to a large business, then they find it very difficult to work in the same kind of time scales. So that can be a problem. Sometimes it can be, especially smaller businesses, haven't yet got the hang of getting their invoices correct, so they haven't put the purchase order number on it, or there might be some kind of mismatch between the ordering department and what was on the. So there might be all sorts of reasons. Those kind of things usually get ironed out, but they all take time to iron out. And we work with businesses. We understand those sort of issues. Well, the number one tip is get your invoices out on time. Don't wait till the end of the month. When you've completed a piece of work, get the invoice out. That can accelerate your payment terms by 30 days very often. So get your invoices out on time. Make sure you send out statements. It reminds people that they do need to pay. Don't be afraid to call accounts payable and say, can you tell me when my cheque is going to be sent out or when my bank transfer is going to be? Most businesses understand that that's, they've ordered goods. Do a credit check. It is astonishing how many small businesses assume that just because the three magic letters PLC appear at the end of the name, that somehow that guarantees payment. It doesn't. So they really do need to do a credit check. There are some free credit checking resources. Some banks offer it. There's a site called DueDil, which you can go on and you can get a very top level assessment of it. It wouldn't be good enough for our purposes, but it will give you an indication as to whether this company is good for the money. And if a company isn't good for the money, don't be afraid to get at least your cost element up front, because you really do need to make sure that you as a business are protected. So those things make a massive difference. Once you've done all those things, then you can start looking at forms of finance. But very often that will improve your cash flow hugely. And the other thing, and this will be music to your ears, forecast your cash. If you're not forecasting your cash, don't be surprised that you get it to the end of the month and run out of cash.
That's an amazing number of companies that
Isn't it just?
Well, great. Well, thank you very much, Barry.
With you is my pleasure.